Our agenda today, we're pleased to start with Swapna Pillai, the head of research for Savills in the Middle East, who will make a presentation to introduce the topic. And then that'll lead us to a panel discussion with Simon Smith, the head of Savills in Hong Kong of research and consultancy, Dr. Christopher Payne, the chief economist for Peninsula Real Estate Management in UAE with a focus on Saudi Arabia and UAE, and the distinguished Murray Strang, the head of Savills Dubai and one of the leading experts in real estate investment in the region. I'm David O'Hara. I'm the head of Savills in Saudi Arabia. And before we begin, I just wanted to say that we have received some questions from the participants here, and we're going to include those as well. And first, I'm pleased to start with Swapna Pillai and his presentation. Please, Swapna, go ahead.
Thank you very much, David. Hello, everyone. In the inaugural presentation last week, our global research team gave us some interesting insights on how real estate from around the world is undergoing transformation driven by technological, demographic, and geopolitical factors. Global investors are at the forefront of this change. They spearhead investments in emerging markets and provide leadership for transformational issues such as sustainability and climate risk. But how are these investment strategies evolving in the backdrop of trade embargoes and a growing protectionist mentality? The Middle East has traditionally been a net exporter of capital. Sovereign wealth funds and PE funds have been some of the biggest investors into equities and trophy real estate assets over the past decade. However, in the last few years, governments in the region have been encouraging foreign inward investments to drive growth and diversify their economies. In 2019, the United Arab Emirates was the largest FDI recipient in the sub-region, with flows of almost $14 billion and growing by almost 32% from the previous year. This was largely due to major investment deals in oil and gas, primarily in Abu Dhabi. In the same year, the country further strengthened its commitment to foreign investments by launching a broad-based initiative to enhance the commercial ecosystem. Meanwhile, capital flows in Saudi Arabia also increased for the second consecutive year by a further 7% to $4.6 billion. The new investment policy and a broader economic reform program under the Saudi Vision 2030 are intended to further improve the country's investment environment and promote economic diversification. Several large non-oil investment deals took place in 2019. For instance, the large greenfield project implemented by Pan Asia PET Resin from China, a plastic bottle supplier, which launched a facility in Jazan city valued at approximately $1 billion. Other countries in the region have undertaken new measures to promote inward investments as well. Oman, for example, has set out a series of laws governing public-private partnerships, privatization, and foreign capital investments, with the aim of creating a more favorable regulatory environment. Bahrain now allows full foreign ownership of companies involved in the activity of oil and gas drilling. In Egypt, economic reforms constituted by the government have improved macroeconomic stability and strengthened investor confidence in the country. Although FDI in 2019 was still driven by oil and gas industry, investments have been made in the non-oil economy as well, notably in the telecommunications, consumer goods, and real estate sector. However, as per the UN Conference on Trade and Development, global capital flows will be under severe pressure this year and is expected to fall by almost 40% in 2020 from the $1.5 trillion witnessed in 2019. Capital flows in emerging countries will be hit especially hard, and this does not bode well for countries in the region that are pushing ahead with their diversification strategies and liberalizing foreign investments across sectors. The immediate impact of FDI inflows will be due to COVID-19. However, long-term, a push for supply chain resilience, policy shift towards more domestic investments, and local manufacturing could have lasting consequences. Trade wars could also impact how and where investments are made. Our research shows that China now plays a significant role in the Gulf and North African region. Between 2014 and 17, the Middle East total Belt and Road funding was $71.1 billion. Will we see further investments by Chinese companies and government in the region? As diversification takes center stage, what sectors should the region develop and specialize to drive further economic growth? And how can Gulf economies adapt and make the most of the changing landscape, especially with regards to real estate? We aim to address these questions and other pressing issues with a panel of experts over the next 40 minutes. We hope you find the sessions insightful and thank you very much for your time. Over to you now, David. Thank you very much.
Thank you very much, Swapnil. That was a very good background that you set, and I appreciate that. What I'd like to do, I'd like to again introduce, I have Simon Smith, as I mentioned, the head of Savills Consultancy and Research in Hong Kong, Murray Strang, head of Savills in Dubai and investment, and Dr. Chris Payne from Peninsula Real Estate, chief economist. And first, I'd like to start out as a transition from Swapnil's comments. Simon, I'd like to ask you, as a long-time Hong Kong resident, I'm sure you've seen a lot of many significant changes come on. And one of the things that Swapnil discussed was the Belt and Road Initiative. I'd like you to just briefly introduce that, and if you could, maybe how the BRI would evolve in the current landscape.
Yeah, sure. Thanks, David. Yeah, so the Belt and Road Initiative was something announced by Xi Jinping as long ago as around 2013. It mostly concerns opening up new markets for China, securing a global supply chain, and helping in turn to generate sustained growth within the mainland. There are two main components to the Belt and Road Initiative, the BRI. One is the Silk Road Economic Belt. And if you can imagine, that comprises 3 land routes from China to Europe. One runs through the north, through Russia, into Northern Europe. One runs through Central Asia into Europe, and one runs through the Middle East into Europe. So those are the land bridges from China into Europe. The fourth is a maritime Silk Road. And this is particularly important for the Middle East because, of course, China relies on a lot of its sort of energy imports to come over the sea rather than over land. And the Middle East is also quite a strategic location, in terms of it being the place where sort of Asia meets Europe, is that fulcrum and strategic position. So a lot of China's trade with Europe has to go through that part of the world as well. So its strategic importance is quite marked for China. So the BRI was all part of that.
Okay. And how do you see that the BRI evolving in the current landscape?
Well, I mean, in several ways. I think what we're seeing out here in Asia Pacific, and I think you're probably aware of it in the Middle East and Europe, but enormous trade tensions are now developing between China and the US. These trade tensions have been very apparent since about 2018, and really the seeds were sown in 2016, perhaps with the election of President Trump. And the advent of a rising trade deficit with China, manufacturing shifting to China, hollowing out manufacturing in the US, a perception that that perhaps there were unfair trade practices going on, that there was IP theft. And this was all stoked by sort of rising populism, both in the US and in China. And of course, over the same period in 2013, not only did Xi Jinping announce the Belt and Road Initiative, but also something called China 2025. And this was China announcing its intention to dominate certain areas of technology and industry. And this is something else that sent alarm bells ringing in Washington. You add to that a sort of militarization of the South China Sea and a more authoritarian government in China, and you had the recipe there for a lot of tension. So these tensions have broadened. They began very much being about trade, and then it became about intellectual property, and now increasingly it's about finance, and then behind all that there's the geopolitical issue as well. China, from China's point of view, they see a US that's keen to ensure that it does not become a significant power over the next few years. The reality, of course, with China is it is very much an economic power, not yet really a political or a military power. But this is all fed into those trade tensions, David.
Right. And another thing that Swapna presented, he had the discussion on the foreign direct investment in the Middle East. And I wanted to ask about how the current trade embargoes and pandemic would be impacting the Chinese companies' investors in general, and then a little bit more specifically, any potential impact on the real estate.
Yeah, I mean, there have been huge implications. I mean, the interesting thing about COVID-19, and something that we're always asking ourselves, is it a disruptor in and of itself, or is it simply an accelerator? Has it just accelerated trends that we were seeing pre-outbreak? And I think in my mind, particularly in terms of the trade tensions, it simply accelerated what was going on before. So some of the key real estate implications of the trade war have appeared writ much larger now. So manufacturing, for example, was already leaving China pre-COVID, pre-geopolitical tensions. It was simply a fact that land and labor costs were rising in the mainland, that China was moving up the value-added ladder. It was more interested in producing high-tech goods rather than t-shirts and trainers. So a lot of that type of manufacturing was moving off to India and Southeast Asia, for example. China was becoming much more reliant on its domestic economy for demand, particularly local consumption demand. And it was also looking, China as for the last sort of decade or so, China offers very few domestic routes for investment. And it's always looking overseas for diversification, and for higher returns. Traditionally, it's often looked to the US and to Europe as markets that are quite deep and liquid in real estate terms and offer a good home, particularly to funds that are very core-oriented. They like sort of first-tier core assets. Now they might start looking to the Middle East as the next step. As tensions rise with Europe and North America, the Middle East suddenly becomes...
And that leads into today's discussion. Chris, I wanted to ask you, back on the Belt and Road Initiative, what impact do you feel that it'll have specifically in the Middle East, as in particular with the real estate?
Well, I guess I wanted to talk about the impact that trade wars could have on Belt and Road, because I think, and how that could impact the Middle East, because I think one of the important things to realize about Belt and Road is what is funding it, which of course are these huge trade surpluses that have turned into huge amounts of foreign exchange reserves that the Chinese have built up, really since WTO entry 20 years or so ago. And so if we do see trade wars, then I think it'd be expected that some of those trade, that situation, that trade deficit, that trade surplus, those imbalances with the US will begin to lessen. And so you may see a slowdown in the accumulation of FX reserves, which of course may mean less funding for Belt and Road. Now, one of the very specific ways we could see that, for instance, is that we know that in Dubai, all the biggest four Chinese commercial banks all have based their Middle East and Africa headquarters essentially in the DIFC, and have built up reasonably large balance sheets, managed their balance sheets from the DIFC, not just in the Gulf, but beyond. And obviously, to some extent, that dollar lending is itself a reflection of FX reserves that never came back to the PBOC. So again, that there is a risk there that Belt and Road, whilst it will obviously continue, we may see less funding going its way, and we have to understand where the funding has come from for it. But obviously there are key countries. I mean, Oman is a country that as we know, has already had significant amount of Belt and Road investment in some of its ports like Duqm, Salalah, and that's obviously a very important port for China, particularly as it for many of its infrastructure investments in East Africa. So Belt and Road is here to stay. It's a key part of President Xi's
Well,
policy.
Chris, you mentioned part of that leads me into the next point on the protectionist policies of the world's two largest economies. They may cause a disruption of globalization, and I would just like to hear from you what you would expect of potential impacts on the Middle East economies would be, both good and bad.
Yeah, okay. So I think let's start off with the big picture. So, and I'm going to take numbers from the IMF. IMF basically said, if we see a ratcheting up of tariffs, essentially those tariffs that weren't introduced but were threatened, and we see significant reshoring of production, say we see a 10% reshoring of manufacturing capability, then their view is that we would see probably potentially 0.5 percentage point less global growth going forward. So global GDP would be, say, 3 percentage points a year rather than 3.5 percentage points. So percentage points, yeah. So obviously, in itself, the direct impact of that could be on demand for oil. We've seen historically a correlation between the oil price and demand. Now, we know oil price is a function of supply and many other factors. But that's obviously very significant if we do see less demand for oil and lower prices as a result of it. Even now, the last 5 years of the Gulf, if we think about what's happened in the local economies, it's been about fiscal control. Oil prices fell at the end of 2014. Government revenues were 90% came from oil and gas in 2013. And as a result, surpluses turned to deficits. We've seen austerity. And that's really been the key behind real estate price weakness. I think a lot of people focus on this excess building, particularly when they look at, say, Dubai. And of course, there has been a lot of building, but the real issue has been much slower economic growth domestically, which has led to layoffs and a much slower growth of the population that was previously expected. And even in some cases, some population shrinkage. And that's definitely a function of, we're going to see that with COVID as well. And obviously it's because of that we could see less demand for real estate. So it's really been a demand story, and trade wars could exacerbate that. Now, I will say that there are a couple of potential silver linings as well. I don't want to be entirely negative. I mean, one is to point out that actually deglobalization could mean the setting up, fragmenting of one sort of global supply chain into many, which actually, although it's inefficient for the world, it may be good for oil demand and transportation costs. So we may see some support in oil prices there, which would certainly help this region. The other thing is, of course, is dollar weakness. And, if we do see potentially less of imbalances between China and the US, we see less recycling of money into US dollar assets, and we start to go from a period which has really lasted 15 years plus of dollar strength into a period of significant dollar weakness. And of course, that would certainly help relative, in terms of how foreign investors look at real estate prices in the region. So that actually may, supply some support as well. It's a very complicated issue. You can see.
Correct. But Chris, how can the GCC economies adapt under this changing landscape, especially again with the real estate focus?
Yeah, I mean, it's a very, I guess there's a sort of a bigger picture about how, these economies, all these governments are desperate, for instance, for foreign investment into the country. And obviously China is a major source, as your excellent introduction showed, of foreign investment. So there's a very fine line to walk at the macro level in terms of trying to appease a US that wants technology. Huawei, they don't want Huawei components in 5G networks, so you want to appease the US, but you can't stop Chinese investment coming in. So, I think part of the question is in terms of how these governments walk that fine dividing line to keep everyone happy. If they can keep everyone happy, then actually they have the potential to again feed off both kind of trade networks. Okay, so that's one answer to that question. I think the other answer to the question in terms of how these economies continue to diversify and in terms specifically in terms of real estate. We're already, to some extent, we're already seeing expansion in spaces like Dubai of medical services. Okay, we're already seeing large boosts into the tourism industry in order to attract more visitors. I think longer term, obviously, there is going to need to be a focus on technology, on building domestic human capital, as people, as economists call it, in terms of education, to just ensuring that there is, a competitive center of innovation in the Middle East, and they can take advantage of those perspectives. I mean, we all know that, improving logistics facilities is incredibly important, not just in terms of ports, where I think there's huge amounts of technology that could be introduced in many of the major ports like Jebel Ali, but there's also in terms of ensuring that consumers that their demands can be met through e-commerce as well as in physical infrastructure. I mean, we ourselves, I think it's an obvious thing to say, but one could think very much about being long. We talk about being long logistics, short retail. I mean, that's obviously something that's very important from an investment perspective.
Okay, and so for the sectors that you see in the region developing to drive the future economic growth, you're saying so it would be, logistics would be one. Where else do you see that? I mean, given the socioeconomic and demographic profile of the region.
Yeah, so I mean, let's think about Saudi, for instance. I mean, obviously, we do think that within Saudi Arabia, there's actually, a very interesting sector would be residential for Saudi nationals, because there we are seeing a very strong domestic policy with regard to trying to open up the mortgage markets. Now, this is something we've seen across the world. UK is a classic example of where in the early 80s, home ownership became an important government policy. Banking liberalization occurred to allow people to borrow and meet their borrowing needs. And that was the beginning of the long bull market there. In Saudi, we now see, just look at the end of last year and the expansion of mortgage lending among the major Saudi commercial banks. It was incredible. And what home ownership is, what, 30%, 35% among Saudi nationals in Saudi Arabia. That's an very potentially huge change, and obviously relates to the ability for banks to give mortgages and to foreclose at the same time. So that's a very important development, something we're watching very carefully. As I said, logistics, manufacturing, these are all, educational facilities for nationals as well is something that is still, potentially very, very important, particularly in the private sector, where we're seeing population growth there.
Chris, you mentioned the home ownership among Saudis. What about the leasing residential market among Saudis? Do you see that is an investment opportunity? There's a very small number of properties, real estate investment properties, that do have it. And this is something Murray, you get ready, because I'm going to follow up with you on that one as well, because of the impact that'll have. Yeah,
I mean, I think it's true. I think family unit sizes in Saudi Arabia are still generally household sizes are generally large. So I think that there is, as we see a demographic shift, a younger population adopting more, I guess, Western practices of wanting their own homes and dwellings, if you like, then that's also important. And of course, that's going to be driven by the whole, again, it will be driven by a demand that people have for their own housing as well. They may want to lease and then later on want to buy. So absolutely.
Murray, on that similar vein, do you see that there will be a number of investment opportunities? And yes, I have a Saudi bias on this, in Saudi Arabia for developments to come in with an intention of leasing residential as a viable option to people who would, in other cases, maybe get a mortgage and buy a first home?
Yeah, definitely. I think there's clear indications, both from a Savills focus and a global focus, on markets such as Saudi Arabia and particularly Egypt in our mind as well, in terms of potential growth over the short to medium term, just based purely on population numbers, on the scale of the markets, on maybe the amount of ground that they have to make up on some of the other more established markets, both in region and globally. I think that a lot of eyes are on Kingdom of Saudi Arabia at the moment to see how they adapt to that requirement for housing. And there's not many places around the region, Middle East, GCC, where that huge level of growth and that obvious demand is sitting there in market, ready to be taken advantage of. I think that There's also an element of hesitancy about the intricacies of the Saudi market, and that, you know, is part of my view on Middle East as a whole, is that foreign direct investment both into the region and around the region is quite hesitant about a clear understanding of the legal framework, the tenure of these assets, the ability to then export capital back out of these countries. And I think that, you know, we're punching above our weight against a huge amount of international, well-established, transparent behemoths when it comes to international global investment. And I think the Middle East is catching up very quickly, but there's still a lot of intricacy about the local markets and the way that the local markets operate that international investors have to become au fait with and understand in every element before they're happy to put the huge sums of equity that are required to really move the dial in these types of markets.
Okay, well, Murray, we've heard what's happening with the BRI from Simon. Chris discussed some of the sectors, you know, for driving economic growth. What do you feel that the GCC countries need to do to drive the countries need to do to drive the economic growth?
Yeah, I mean, I'm delighted to piggyback on a number of the comments there from Simon and Chris, very relevant to the GCC markets. Particularly, you know, when you look at some of the countries that feature in the top 10 of foreign direct investment around the world, the likes of the US, India, China, you know, clearly they are huge markets. And you know, Simon touched on the depth and the liquidity of markets being very important. And I know from a Middle Eastern exportation of capital, you know, the scale and the depth and the liquidity of these markets, coupled with the length of time that they've been established, that makes them very attractive to Middle Eastern money, because that's something that we're trying to catch up on here. We see markets like India and China with populations of 1.3, 1.4 billion, the US up in 350 million, and here right across the GCC we have, you know, a population of about 55 million altogether. So we're still well in the slipstream of these other countries that are in the kind of top 5 for global financial investment, and that's what we have to do. That's what we're competing with, not only to attract global capital, but to retain outgoing local capital as well. And that's not to mention established markets like Europe and the UK, where there's a huge history of foreign direct investment. So I think, you know, the growth of population is incredibly important. Economic stability moving forward. I mean, real estate investment is especially when it comes to global investment, is far less about the bricks and the mortar and really the level of development going into these markets. It's a lot about buying that income and investing into that security and that length of income.
Okay.
Having a clear foresight and confidence about the risk adversity of that income on the investment, and you're competing with, you know, equity, dividends, and all other investment classes, and it's a clear focus on how long and how secure is that income derived from the property. And, you know, freehold property in Middle East, for example, is what, 14 years old. I mean, it was launched in 2006, and we've gathered international investment hugely in that period of time. But to expect, you know, something that the small scale that the Middle East has to offer compared to a lot of these other countries and regions around the world, and the length of tenure that we've been competing in the market, I think, you know, there's a lot of positivity to be said about the progress we've made in that time. It's no surprise that possibly we still wait in line behind some of these regions. But I think we're catching up quickly, and I think that will continue. It's really difficult to comment right now because we're in the face of such unprecedented conditions this year. And actually, it comes off the back of a huge amount of progression and growth that we saw throughout 2019. And we touch on, you know, the residential market in Dubai, for example, has long been viewed as quite a soft market over the last 4 or 5 years. And a lot of that is down to the huge levels of development that have occurred. But actually, the demand, the transaction numbers, the capital inflow, and we were up, 2019 was up transaction numbers 25% year on year on 2018, which, you know, annual growth year on year, 25% transaction levels is huge. And again, the first quarter of this year, residential transaction levels were up 10% again on Q1 2019 year-on-year transactions. So we were starting to build, good momentum in terms of growth of transaction levels. Yes, okay, development levels were still high, so we were still seeing contraction of prices and rents, but the market was really starting to catch up with itself. And clearly with sectors like aviation and hospitality that Dubai and the Middle East rely on so heavily, just having such a period of lockdown and closure over the last 3 months has really hit the economies in a big way. But I think that we've already started to see huge progression in levels of that easing. And I hope that, once we hit Q4 of this year and onwards into next year, we will start to regain ground and see a lot of that historic progression that we were experiencing over the last 18 months.
Very good comments, Murray. I appreciate the insight. I have a general question. I'd like to go around and ask all the panelists, if I may. And it's really, I'd like to know, Murray, I'll start with you on this one. Do you feel that there is an increased China, Middle East, North Africa relationship as a formula for success? What do you see on the upsides and downsides of the China, following up on Swapna's presentation with the FDI coming in BDI, the BRI? How do you feel on that?
Yeah, I think over the last couple of years, we've definitely seen the Middle East emerge as a real target market for not only Chinese money, but Far Eastern money. We've seen strong interest from the likes of Korea, Singapore, Malaysia, all looking at the Middle Eastern market. And I think that's indicative of us pulling into a period of growth and uptick and real sort of indication that there's strong value in the market, and that where some people doubt it, those that really understand the fundamentals of the markets here and probably in the most part are prepared to joint venture partnership with local entities. I think that's where we've seen a huge amount of international investment into both the real estate markets here and just generally into markets, whether it's acquisitions of locally founded businesses, the Amazons and the Ubers of this world coming on and taking like-minded businesses that have been grown locally, or investment into the likes of ADNOC in the oil sector in Abu Dhabi, or joint venture partnership in real estate like we've seen, for example, with Brookfield here in Dubai, who've built up a huge presence with ICD Brookfield Place and DIFC, which will due to hand over very soon, a prime grade A office building here that will undoubtedly change the office landscape right across Dubai and the region, and also with their joint venture with Miras on retail assets, having founded the Mirex group. So Brookfield, Canadian-backed money, is a very strong example of an entity that really have partnered with strong local groups and become part and parcel now of the local market over a sustained period of time. And I think that's the best approach that I would imagine Chinese and Far Eastern investors and groups are looking to gain a foothold in the market. And I think once they're able to do that and gain entry into the market, I think that once they start to gain an understanding and a track record and experience in the market, then they will start to see the level of opportunity that's here. And I think possibly that will start with more established markets, potentially like Dubai and the UAE, and then it will grow into Saudi and Egypt and other larger scale markets around the region.
Okay, Simon, I'd like to hear from you well, Murray gave us kind of the GCC perspective on the China Middle East relationship as formula for success or not. I'd like to hear your perspective on it from kind of the other side of it. What are your thoughts?
Yeah, I think there is the strategic considerations to think of first. What does Chinese capital want when it goes overseas? It wants risk diversity. For a lot of entities that are overly committed domestically within China, you're almost by definition long developing economies. You're looking for more opportunities and you're looking to diversify risk. The Middle East may play well to that. I think also, you know, the Middle East increasingly does offer itself as a sort of safe haven. It offers capital protection, which again is a lot of what that money, what those funds are looking for. If you've got depth and liquidity in your markets, that helps enormously as well. And traditionally, that's been the attraction of Australia, Europe, and the US. The other thing, importantly, you have to offer is a sort of economic and economic stability and political consistency, I would say, rather than any particular complexion of politics. I think consistency is most highly valued among investors. I think at a sectoral level, though, that's quite strategic. You know, you've got to see where the opportunities are. You know, and Chris was talking about logistics. That's been a huge sector out here in Asia Pacific. In fact, arguably now it's probably looking in many jurisdictions a little overvalued. It's been so popular for the last 5 years or so. It's quite difficult to find anything left within that sector. But it seemed to me, looking at the Middle East, you know, there's so many opportunities in infrastructure, logistics, data centers, probably multifamily you were talking about earlier. You know, it's all there. I think China would also look to invest. I mean, Chris was talking about, you know, the opportunity to invest in road and rail and ports. IT infrastructure is also now being added to that. You know, the likes of Huawei putting in that, those levels of investment. So yeah, there's plenty in the Middle East, I think, to appeal to mainland funds. It's just about putting those. Actually, the last word on this, you know, Chris talked a bit about de-globalization as well. I'm very much in favor of re-globalization. I think globalization is finding new ways around the increasing sort of political landscape. You know, perhaps, okay, it's not all about China anymore. Perhaps there'll be a greater reliance on India and Southeast Asia. Yes, there'll be a bit of reshoring, but, you know, the Belt and Road might compensate for perhaps more limited supply chains elsewhere, given protectionism. So it's a sort of rebalancing of globalization rather than, I think, across the board de-globalization.
Thank you. Chris, I wanted to ask you a similar question, but add a twist to it. As today's topic is the US-China trade wars, and as the token American on the call, what about the US side of this? Or really should we, in the Middle East, really be focusing on investments coming in from China?
Well, so, I mean, to start off with that, it's not that the US aren't huge investors around the world, but obviously, you know, China and other East Asian countries, Japan, that have run huge current account surpluses for so many years, do have FX reserves to invest. So, I mean, I'll come back to it, but just to pick up on a few of these points. I mean, I think there are some very significant positives from MENA when trying to attract investment from China and the Far East. And I think one of those things is, particularly China, if you invest in the region, you're not investing in US dollar debt. And I think I think there's probably a fair amount of desire, I can imagine, in China to stop buying US dollar debt and to stop that sort of support, you know, essentially buying green pieces of paper. It doesn't, you know, I'm sure, and that's why we've seen these banks, Chinese huge banks, set up around the world and recycle these dollar earnings without them having to go into, you know, official forex reserves. So that's obviously, looking for places to invest is very important. And MENA offers, you know, the whole region offers some significant pluses, I think. I mean, there's huge amounts of potential productivity gains. I mean, you can always look glass half empty, glass half full, right? But the reality it is, there's much that can be done with productivity and growth and development and education. And that's potential for profits and growth. So that's an important thing. And obviously there's a very young population. It's growing very fast. Now, of course, we know some of the challenges in some of the countries with high expat populations. I've mentioned that already. But across the region, growth of North Africa particularly is hugely, you know, is a hugely potential growth. And so obviously countries want to be in at the start of that if they have investment dollars to invest. And I think that somewhere like the UAE, and I'm particularly thinking about Dubai, it can still gain hugely out of that development. I mean, Dubai is now the place where a lot of young people from the region, from Morocco, all around to Lebanon, that's where they actually want to come. If you ask people where they want to come, it's actually to Dubai. There is a huge potential to Dubai to really benefit from growth that can come from foreign investment that wants to come here. And I think, you know, when we talk about global investment, I mean, I suspect, you know, the United States is more interested in what's going on in its backyard and in the Pacific, to be perfectly honest with you. But if we talk about any global companies that looking at this region, obviously supply side reform is really key. It's about, you know, and we've seen change in the last couple of years. Foreign ownership onshore, it's obviously a critically important facet of that. Ease of doing business, ease of setting up, some of the, you know, general commercial laws and legal systems, and all of that. It's a lot to ask for that to happen overnight, but we are seeing change, and that's obviously a beneficial fact as well. And, you know, final point, I guess, coming back to Saudi residential, I think that the whole mortgage reform and advance of that just shows what can be achieved by appropriate supply side reform. And I think that will, you know, the sort of longer story in the region is that it's going to help domestically and it's going to help in investment. All of these things are entirely, potentially very positive, but it will take time. And obviously in the next 2, 3, 4 years, we're still expanding outside of that very oil-centric economy, and governments are still trying to put their fiscal situation onto a sustainable path.
Thank you very much, Chris. And what I'd like to do, I'd just like to ask each of you for your let's call it a sound bite to wrap this up on the whole idea of we're in challenging times and we're possibly in the middle of on the sideline of a trade war, global trade war going on. Murray, do you have any final comments you'd like to add on this?
No, I think stick with it would be my message to the local market. I think we've got a fantastic product here. I think we were making great inroads into attracting foreign direct investment over previous years. Even just in the last 3 months, the amount of rebound and bounce back in terms of the activity that Savills are seeing here across the region, and particularly here in Dubai, we've got a full workforce back in. We're taking more calls than ever, and our demand for our services is right back at where it was pre-COVID. So I think a lot of the fundamentals that we've discussed make Dubai and the Middle East a very exciting place to keep an eye on and consider, in line with a lot of other global competition for placing your money and seeing good returns over the long term.
Thank you. Simon, any final comments on this?
Yeah, I think the next 10 years are going to see such phenomenal rates of change at so many different levels. You know, just look at how the world is changing demographically, geopolitically, technologically, environmentally. I think it's going to be a terrific decade of both challenges and opportunities. It's how the investors are going to play those.
And Chris, my question for you, is this a black swan moment?
Well, it's certainly, I'll tell you what, if you're an economist trying to forecast things, then it definitely is a black swan moment, because you can't build a black swan event into your economic forecast. But I will, back to your other question, I will just say, we must remember that countries like Saudi and the UAE have huge amounts of sovereign wealth, okay? And because of that wealth, they have the potential to make investments and to cover the deficits that arise out of COVID, to fund them without having to necessarily go to international debt markets. They're fiscally sound. The challenge is using those funds to invest properly, to diversify the economy, and to ensure that, you know, whilst at the same time ensuring fiscal sustainability. Get it right, and it could be very positive.
Great. Hey, look, I'd like to thank everybody. Swapna, I appreciate the way you set up the topic. It was very a good background for it. Simon, appreciate you coming in from Hong Kong on this. Chris, your insights from, you know, the chief economist perspective are very helpful. Murray, I understood most of what you said. Very good points on this. We can work on your accent later. But thank you all very much for this. And of course, we couldn't have done this without the marketing team who put it all together, and the research that went behind it. This is just the first of a series of discussions we have. We look forward to the next one. and we can take any questions offline. So thank you all very much.
Thank you.
Thank you.
Thank you, David.